Righto, buddy, miners. Bloody the quarterlies bloody continue. What do we got today? We've got a bit of the bloody copper and zinc going on. Sandfire, 29 metals, Aurelia. Some bloody heavy decline in one of those stocks, money miners. We're bloody getting into the mining services today, boys. Mater. Very interesting business, this one I've worked alongside and learned a lot more about it today.
It's had a big impact on the mining industry, Matty. Story we should probably tell.
One very rich fucking bloke that owns it. Jesus Christ. Mate, the sin bin. What have we got? Hastings, Vulcan and Lake, unfortunately, in having 10 minutes off the field.
Three stocks in the sin bin. Might be longer than 10 minutes. Yeah. I can go on a rant, Matty.
We'll go through the goldies too. The ones that are making cash and who's making the most cash to relative to their market cap.
I saw you making a very pretty chart, Matty.
I will just let everyone know right now that Trav sexed it up for me. So
Matty Michael, the investment banker, hey?
Yeah.
He's making a transition. He's making a rapid transition, JD. I think he's gunning for a gig in the old IB world, that's for sure.
Just had a bit of a bloody twist there, lads. Got to be comfortable while you're ripping it out. Mate, boys, we love M&A. I have identified in the private business world, within the mining industry, that there is a potential merger on the cards. One that I see logic. It's nearly as logical as AVL and TMT.
I trust you'll clip the ticket on this one too, mate.
Well, and consider this the initiation, I say. I just think these companies have some good synergies, and I'm going to tell the money miners why, and I'm pretty bloody confident on this. So, as we know, we highlighted last week, Trav.
Yeah, mate.
We know MMTS stands for Managing Mining Tenements
Superbly. Or sensationally.
Sensationally. Any superlative could be that S word you'd say. Mate, unbelievable business, this one. Talk about scouring the country for tenements.
It's a really good business.
Remember telling you about the state-of-the-art cutting-edge tenement management bloody software they build in-house? It provides that Google equivalent to tenement management.
You're 100% right. I don't know where you're going with this, by the way, but I actually think there are parallels between MMTS and Mater, which we're going to talk about later. Both have cornered the market.
Exactly. Well, maybe there's another full solution there. Hold that thought.
We'll hold that
thought. Mate, this software that they've developed, mate, VCs from Silicon Valley are apparently knocking on the door because they want to IPO it. Like, this is the sort of level we're talking about. This is some of the brilliant stuff that comes out of WA. But, mate, I'll tell you what, good luck to them if they want to get past Eva Morell, the head honcho for MMTS. I reckon she'll tell them to fuck right off.
Mate,
Not a chance. Yeah, mate, if you can get this out of get that out of Eva's hands, bloody good luck to you, but you will not. Mate, they've just got that foothold in WA. And because of that excellence, they have expanded. New South Wales, Queensland, Northern Territory, South Australia, mate.
A bit like Mater expanding overseas.
Well, and look, the one thing that I see that separates them is same as anywhere. It's like being in the office on a mine. It's all good on paper. You got to see it with your own eyes, and they take that very seriously. They want to see they've got the software, but they want to see the tenements. This is where Brooks Airways comes in. Mate, talk about the Brooks King Air and the Brooks Learjet taking the MMTS crew over the top to visually check these tenements before they snap them up for their clients. Like, mate, and look, this can go even further, like into, as we keep mentioning, that full turnkey solution for mining tenements. So let's say like MMTS secure the tenements via the software after checking them with their own eyes via the Brooks King Air or the Brooks Learjet, and then to take action on that tenement, that MMTS managed tenement, that's where the Brooks Hire division steps in. And mate, provide you all the necessary equipment to start exploration, graders, diggers, water trucks, rock breakers, all the trucks to fuck the dirt off. Mate, lighting towers so you can actually see how beautiful your tenement is 24 hours a day.
There might be only two companies you need to go do everything from pegging ground all the way through to bloody extracting rock. And I think it's these two companies.
I think it is, mate. And even to the level you chuck your Brooks donger on there for accommodation with your Brooks shitter outside. Like, mate, there is just nothing that these two companies could not achieve together. So I'm putting it to the private market. I think welcome to Matt Michael's new corporate advisory firm.
Michael merger.
MMA, Matt Michael Advisory. Oh, fucking I love it. Right, Brooks Airways, MMTS, soon to be one. But bloody talk about two unbelievable businesses that support our show. Bloody legends. Love your work. Thanks, Stewie Brooks and the crew at MMTS.
Shannon McMahon. Yeah, thank you very much, guys.
Shannon's been hanging around with the Barmy Army, I've heard. He's
watching some cricket.
I think he's a cricket fan. He's been over in India with the Barmy Army. So
India with the Barmy. Oh, there you go.
Mate, a man that
most of the
gets
ads
around.
most of the ads are pretty rogue, but then when you start to go off the script at the end, after the script's pretty rogue, that's when I start to get concerned, Matty.
I will admit I get great joy in egging him on, JD, and it's easy to egg him on when you're not here.
Yeah, just pipe down there in Victoria, mate.
I can see the smile on your face, Trav.
Righto, what's going on? Base metals. Who's flying the flag today, JD, in the base metals department? Start off with Sandfire. What are they up to?
Alrighty. Well, we'll start with the biggest Sandfire. So up, a few percent, 3 or 4%, trading at over $7. So pretty fully valued. That an okay result overall. I'm not sure about you guys, but when I read through the Sandfire announcements and the quarterlies, I can't help but think they're trying to do everything they can to just confuse us. They're throwing in all these numbers, all these copper equivalent, but it's very hard to actually work out whether they made money or not, which is what you want to know at the end of the day. So we'll get into that later, but looking at production for the quarter just gone, 32,000 tonnes of copper equivalent. So that was up 5% quarter on quarter. And for those wondering what copper equivalent is, pretty much Sandfire mines a bunch of different metals. The primary metal is copper, but they've also got zinc, gold, silver, those sorts of things. So they just want to sort of display that to investors in simple terms in their primary metal. So they just assume a price for each metal, just sum it up to a total and then divide it by the copper price they're using to see what that equates to. So in copper equivalent terms, they're saying for FY24, they'll produce 135,000 tonnes and actual copper is 97,000 tonnes. So getting into the...
So there's a lot of byproduct in that.
Yeah, there's a decent amount. I mean, other operations have, significantly more byproducts in there. But yeah, I mean, it's just something all these base metal mining companies do. So getting into the various operations. So you've got Matheo, which is the growth sort of project in Botswana. Now that was running at a run rate of 3.5 million tonnes per annum in the last quarter, which is decent. They're trying to get that up to 5.2 million tonnes per annum by 2025. So they sort of got it to 3.2. Now they're expanding it all the way on from there. Although there were some analysts out there saying they were hoping for a bit more from Matheo this quarter. So we'll have to see how that sort of tracks as they continue to sink money into it.
It's in terms of Kalahari copper belt, isn't it, JD? You're a fan of that one.
I'm a big fan of that, mate. And there was another transaction, a big transaction, $2 billion deal by MMG just 2 or 3 months ago that we saw in that same Kalahari copper belt. So very keen to see how that pans out as well. In terms of costs, Trav, I think this one really speaks to you. So they only report a C1 cost. They don't report a all-in sustaining cost, which wouldn't hurt in my opinion. And I can't help but be cynical about companies that try and obfuscate and hide what the actual costs are. So you had a production uplift from zinc that was sort of cushioning a slight fall in terms of copper production. But then you've got net debt for the end of 2023 at US $476 million. They're holding $105 million in cash, and they just continue to put cash into Matheo as well as Matsa, which was bought 3 odd years ago now, and it cost them a phenomenal amount, and it's required a lot of cash to continue to be sunk in there to hopefully in the long term pull down the unit costs and hopefully produce some cash.
So is their net debt going up or down?
Yeah, I've got a comment on that one, but before I touch on that, to your point on the costs, JD, I think the all-in sustaining costs, obviously widely adopted by the gold sector. I think the guidance around that all formed from the World Gold Council. I don't think it is a one of those metrics that's like widely adopted amongst the base metals miners out there. Not to say you don't see it, from time to time.
Yeah,
different
you're
commodities.
absolutely right. That does come from the Gold Council, but you can see other copper companies. It might not be an all-in sustaining cost; it might be an all-in cost or something like that.
Yeah.
Just something a whole lot more reflective of what it actually costs them is sort of what I'm angling at there.
Totally.
But if there needs to be something, because it's an underground mine. It doesn't matter. There's capital development and sustaining capital to get to the ore body. It doesn't matter what's bloody coming out of the ore body. It's exactly the same.
That's why we look at changing cash, Matty.
Yeah.
Exactly. The key difference would obviously be that copper has a bit more, transfer logistics expenses. Much easier just to fly the gold bars out. So beyond,
I think because all in sustaining cost is a cost is per ounce. So that's where it obviously gets confusing because when you got multi-element ore bodies like these ones.
Yeah. And to your point on the net debt, so that net debt rose 22 million in the quarter. They say that's from continuing to invest in Mateo. And but look at the capex, right? So December quarter capex, US 54 million. 30 million of that went to Matza, which leaves at most 24 million to Mateo. So if you ignore the capex at Mateo, they still did not add cash in the quarter, albeit they stated there was a late shipment. So it's kind of I'll look at the cash generation of the business through that lens and sort of think, it's a pretty it's pretty standstill until copper prices elevate themselves.
Yeah, I couldn't agree more, mate. I think the counter to that is that they are continuing to invest in the assets. They're still investing in Matza. Obviously, like we just said, Mateo is still ramping up to that 5.2 million tonnes per annum. But at the end of the day, I think our view is the same as what it was when we first spoke about the company 6 months ago. These are high cost assets, and hopefully they can pull down the unit cost. But Sandfire is really a sort of leverage play to copper and to a lesser extent zinc.
They bought Matza from, was it Traffy? They bought it from. And they had to give up. They had to give up the. Well, I'm sure they don't have a very friendly offtake as a result of buying from Traffy. But heck, they got the asset in a buoyant copper market. I'm sure it'll do well, but they need that buoyant copper market. There's another gripe when I was looking at that net debt number, and you could see the number that they included there. They added a footnote. Footnote C, net debt excludes capitalised transaction costs, leases, and revolving short-term working capital facilities. I don't know about you guys, but I kind of think, like, what net debt number do I want? I just want to know, what do you owe people that you are paying interest on? That's the number I want. Stop. I think don't asterisk it. Just tell me that.
And the interest rate.
100%. I think that speaks exactly to our point of they make it very hard to work out what their actual cash position is, what their earnings are, and those sorts of things. So I think they could improve their reporting.
Right, boys. Speaking of a company that needs improvements, 29 Metals. Another bad quarterly, down 15% during the day, trading at 43 cents. So even well below what they did the bit of the rescue raise at. Not looking good on the 29 Metals front. Unpack it for me, boys.
Yeah, it's not pretty here, and that rescue sort of raise, Matty, was in the high 60s, so it's come off even more from then. They missed consensus expectations, on many different grounds. In today's result, they managed just a few thousand tonnes of copper out of Capricorn Copper, which obviously had that big weather event sort of early last year. On Golden Grove, they did roughly 5,000 tonnes of copper and 20,000 tonnes of zinc. The sort of growth project there didn't really produce the tonnes expected. So for calendar year 23, they missed both zinc and gold guidance, and copper just made it through. But here's where it's sort of really, really bad. The costs came in very high. So their cash position fell from 227 million to 167 million quarter on quarter. Now, 20 of that went out the door to service the debt that they've got, but the rest of that was burnt on the operations. So the outlook is, it's not pretty to say the least going forward. They've got drawn debt of US 146 million, and that sort of leaves a net debt position of 52 million. That's blown out from 15 million just one quarter ago. They've also got another.
I think you can always predict if they're gonna be under guidance on the output, they're going to be over on the cost. It's not like they're taking people away. It's operational performance. So we're always going to see that.
Yeah, spot on, Matty. That's a great shout out for anyone sort of reading through these and sort of trying to get familiar with mining quarterlies. That's very, very common, and obviously
you won't have a low cost, low guidance. I don't think it'd be very rare, if not ever.
Yeah, and to make matters worse for 29M, they've got $26 million sort of on hold. They've got that penciled to go out the door for stamp duty for the acquisition of Golden Grove in the first half of this calendar year. So, on a somewhat more positive front, they're trying to get some money in the door for the insurance claim for that weather event that I just mentioned at Capricorn Copper. So there's a whole bunch of different facets to the claim there, but they've received 24 million already. But taking a step back to just look at the whole company, they've still got an EV of $450 million. And I mean, if there is a turnaround coming, I can't exactly see where it's going to come from, or whether it's coming anytime soon. I'd be pretty suspect.
I think that imagine if they do get that insurance money in the door, imagine the premiums they'll be paying on that insurance going forward after this event.
Yeah,
bloody high.
I remember when you did a really big deep dive on all the elements of that company, Matty. It was yonks ago, but I remember thinking about what you had to say back then and thinking the insurance claim potential doesn't seem as strong as maybe it was appearing. But
and the big thing, I think that insurance always covers surface stuff.
Yeah.
But trying to get it to pertain to underground because it's the water's flowed down there. I think that sounds like that's where it's very difficult, if not impossible.
Yeah, yeah. And it's a pretty scary thing. Like they raised a boatload in that entitlements offer last year. I think it was 151 million from memory.
Which we thought was going to bulletproof them for a long time, but if they keep losing this much, it won't.
That's it, right? It's like, and you already look at their drawn debt. So their drawn debt is US 146 million at 31 December. That's 220 million Aussie dollars. And I don't care if they've got 162 million cash right now. Like, how the hell do you service that debt when neither of your operations are making money? Yeah. And footnote on that net debt again. Look, footnote, unaudited drawn debt amount excludes bank guarantees issued, et cetera, excludes leases, excludes this. Oh, mate, can we just have the simple net debt, please?
Couldn't agree more, mate. This one's the next one we're going to chat about is slightly more positive, I reckon. And, if we'd been speaking about it a year ago, I think the tone would have been very similar to the companies we've just sort of spoken about. But Aurelia, they came out with their quarterly today. So market cap 177 million. They got an EV around that $100 million mark. So been a bumpy ride, but they do seem to be on the way up at the moment. So to give the money miners a bit of a feel for what sort of metals we're talking about here, their FY24 guidance is for, I'm talking about the lower bounds here, over 60,000 ounces of gold, 2,000 tonnes of copper, so not much there, zinc of 18,000 tonnes, and lead just over 19,000 tonnes. So the mines that they've got are Dargues and Peak, plus they've got Federation that's meant to come on in a couple quarters' time. So Dargues did produce a decent amount of cash, but there's no sort of hiding that that's been a pretty shocking acquisition from just a few years ago. The mine is really close.
It was good at the start, I think, when they sold it, but then once they went deeper, the ore body just wasn't as thick and continuous. And whether that was known by the sellers and they bought it, who knows? But yes, it wasn't as rosy as when. Not as rosy now as when they bought it.
Yeah, I think you're hard pressed to spend $200 million on a mine and have it shut in about 4 years, and for that to be a good acquisition. And they came out with a separate announcement.
Good for Pybar. They sold it and they made good money. So for whoever's in pain, someone has benefited from it.
You're not wrong there. The company came out with a separate announcement actually today as well, and they said that the last 2 board members that were around when that acquisition happened are stepping off. So a bit of a refresh since then. So their production for this quarter was 15,000 ounces gold, 3,000 tonnes of zinc, 4,000 tonnes of lead, and just a smidge of copper. And in all-in sustaining terms in gold, it's come out at just over $2,000 an ounce. So here's the cash flow. It's actually pretty impressive. $23 million in operating cash flow. Like I sort of said, a good bit came from Dargues, 13.5, and then the rest came from Peak. Now, this was enough to sort of cover their quarter capex and the bits of exploration that they did. So they end the the calendar year 23 with $108 million in cash. And in early Jan, they got another $18 million in a tax refund. They've also got US 24 in a note that's not drawn. So that leaves them liquidity at roughly $160 million Aussie, but they are guiding to spend Aussie 40 to 50 million at Federation this financial year, so over the next 6 months. So all up, they're a pretty high cost operator, but they've got enough cash and liquidity to keep their head above water for quite a while to come. And I mean, if you're out there looking for torque to base metals and, in a small part to gold, they should do well if those metals perform.
And I mean, the two stories we just told before we talked about Aurelia here, they were Sandfire and 29 Metals, right? And it's long talked about that if you want copper exposure on the ASX, where do you go? Because those two stories we just talked about were they range from unexciting to like scary. And then now we're talking about Aurelia, and they've got some copper production, albeit not loads, but there was the Street Talk article just a couple of days ago about Mac the SPAC coming to the ASX, guys. Did you see that one?
The old
Mick
did. McMullen are taking iron off these nearby assets to CSA.
I saw that one. So the Street Talk article was talking about there's been good interest from funds for the IPO. They quoted 300 million potentially instead of 200 million raising, which will be handy for them because they'd want to deleverage their balance sheet, I reckon. And then, like you said, Matty, there was talk that Mick McMullen was eyeing off some M&A targets already, and they explicitly mentioned Aurelia in that article. Obviously, Aurelia is got those Cobar assets there too. But like you said, JD, when you look at Aurelia now, way better shape than the company was. Just 12 months ago, even 12 months before that. It's been a long time since you've looked at Aurelia and not been, shitting bricks because of the balance sheet. And now like the overhang from Dargs is subsiding and nearly over. There might actually be some substance to that Street Talk speculation after all, but we'll wait and see.
I wonder what the copper price has got to get to really start sparking interest. Like, I think probably psychologically, if it cracks that $4 US a pound, it could be in the news a lot more. It's still sitting at around that mid 380s, which is better than what it was last year. But yes, time will tell.
Yeah, you're spot on, Matty. But the IPO looks hot. I mean, raising $100 more than that was sort of initially wanted or initially flagged, I think goes to show the dearth of copper plays on the ASX. And I think, I wouldn't be surprised if that goes well just as a result of the lack of other plays out there.
And probably investing, because this Mick McMullen, it sounds like he's got a very good reputation for this sort of stuff. So I think there's going to be a bit of investment following it. So which we'd probably seen in the IPO. Boys, let's have a look at bloody MAD. MAD. Yeah, what a good stock code. Mader Group quarterly come out. Buddy, have a look at the God. Talk about a good performance share price graph over the last few years, mate. Just absolutely, pretty much 7x'd over
one of those charts. It's just
since 2021.
It's just up only.
It's just up only. Yeah, she's had a bit of a drop today, down 10% today. But look, I've worked in and around Mader a lot in the mining industry, and I'll tell you a bit about him. Luke Mader, the founder of it, owns 57% of the stock. So it's a $1.2 billion company. He's got 57% of it. So he blows bloody Twiggy and that out of the water of high equity ownership.
Yeah, Twiggy's still got a few zeros on.
Yeah, he's got a lot of zeros on the billion. But 57%. And look, I looked at the director transactions and stuff. Well, hasn't sold any.
Did he sell down in the IPO, or did he just bring new cash in?
Not sure.
Yeah, okay.
Not sure. But look, so Mader is a business. I'll tell you about them. They've just taken this massive stranglehold in maintenance in the mining industry, and now they've even expanded beyond that. So, because a lot of the fitters, so heavy diesel mechanic, we call a fitter, a lot of them, the fitters work for Mader because they love this flexibility. They love having their own ute, traveling around different mine sites. They go on like labour hire contracts at different mines, and they just love it, and they've just secured so many of them. But when mining companies can't get fitters because Mater's taken a lot out of the market. They're forced to use Mater because they've got all the people. So, but to then use Mater to get your fitters on site, you have to pay a premium compared to directly employing the people yourselves because it's a labour hire.
Gotcha. So Mater's cornered the market and they now hire all the fitters. The fitters want to work for them because they get more flexibility and more money, and then Mater basically just charge a massive premium on that onto the mining company, so it increased the cost of the mining company and Mater pockets some of that.
You'd say they saw an opportunity and they just made it happen. Mate, look, 2,900 global employees that business has got now, and over 1,100 support vehicles. So they're bloody massive. And as you said, you can see they've 7x since 2021. And look, because they started out predominantly in Western Australia, a bit in Africa, a bit in Asia. You can see by the growth chart here and where the segments are in their revenue. Then expanded onto the east coast of Australia. They went into infrastructure maintenance and rail services. They've also now penetrated the North American market. Also got their own off-site repair and rebuilds facilities. Like you just see the exponential rise in the revenue from below FY14 in the 10s to 50 million. Now they're up to about 600 million. So and targeting about 700. So it's just huge growth. And that's the thing. There's a lot of businesses out there like this that will labour hire fitters out and everything, but to start those businesses, a lot of risk, a lot of debt you got to take on, you got to have a lot of liquidity to pay your personnel because you're waiting on the company to pay you. So they've just obviously grown and grown and grown. And
then there's scale efficiencies from the logistics element as you grow.
Exactly. So and you look at the percentage of people they've got in the market. So 55% of their workforce is heavy diesel fitters. So that equates to about 1,600 fitters worldwide. Wow. And look, 300 HV and auto sparkies, 260 truck and light vehicle fitters. And so if you look at their revenue if you look at this quarter, 189 million in total revenue, but we're talking mining services, so it's always on EBITDA and margin and net profit after tax how they work because they obviously run high debt models and so their EBITDA was 24 million for the quarter, so a 13% EBITDA margin, and then but if you look at their
still
net
skinny margin, right?
Yeah. So as we said, because they're making like a percentage on top of what they're labour hiring out these personnel for, and they've obviously got other divisions as well now. So their net profit after tax for the first half of this year, 24.2 million, so 6.5% net profit tax margin. So that, I guess that's taken into account your depreciation and because a lot of capital has gone into the business to buy all these utes and you got debt, you got facilities, and so that net profit after tax is like the accounting way to take all of that into account. So they've reduced their net debt position to 40.4 million last quarter. So they reduced it to 35.3, down from 40.4. So it was 42.7 at the start of the financial year. So their FY24 guidance is to hit $770 million in revenue and at least 50 million of that to be net profit after tax. So they're targeting zero net debt in the medium term, along with so they pay out a third of their net profit after tax in dividends. So Mr. Luke Mader, the founder, that's $9.5 million in dividends this financial year to him.
Matty,
on that ratio.
That's why I was so interested to talk about this company today. It really sort of stood out for me because you look at those numbers there and you just sort of solve for whatever the multiple is, given that we know it's a $1.2 or $1.3 billion company. And they're pretty hefty multiples that investors out there are paying. So they're clearly looking at that growth rate that we spoke about earlier and hoping that sustains. Otherwise, you don't see many other mining services related businesses trading on multiples as juicy as these guys.
Wow, it's absolutely huge. So they're specifically trading at 12.8 times forward-looking EV to EBITDA. So, and you look at if you compare that to the peers, I think on the Bell Potter note last year said they're about 2 and a bit times bigger on the multiple they're trading at compared to their peers. Like you look at the mining services in our sort of neck of the woods, like Parenti, McMahon and Emeco, they're forward-looking EV to EBITDA trades at around 2 at the moment. NRW is trading at 4, and these guys are trading at 12.8. So very, as the Bell Potter note says, very fairly valued at the moment. So it's hinging on that future growth. They are paying out that dividend portion, but yeah, we'll see if that growth, it's exponential growth can't keep going forever, but shit, it might.
No.
Who knows?
In the real world, there's always limits to the geometric exponential growth rates.
Yeah, but I think once you get that big, and what they've done, like they've got the brand, like they've just become that generic household name on mine sites. It's like, right, shit, we need fitters. Right, we'll have to get the Mater ones.
Yeah.
Like it's just, they've just taken that absolute stranglehold of the market.
Yeah, and the market's rewarding them with that, really, really juicy multiple that they clearly trade at. So the execution for them to backfill that multiple is just continuing to grow and penetrate the markets which they're trying to go into right now.
Right, now a few goldies come out today, the cash generating goldies, and Mr. Ricardinho in his wisdom, why not compare them side by side, Trav? Get a bit in, just instead of just saying numbers.
Hey, don't give me, this is you. You did all of this. You can't bloody can't give credit to me. This is you were nutting away there, building a chart, working out free cash flow yield of the goldies that reported today. I was very impressed, mate.
Oh, it's a bit like a Saturday night. I did all the legwork, and you got the cherry at the end, Trav. It was a bit like that, mate. I think. But anyway, look, Emerald, Capricorn, Ramelius, and Silver Lake come out with their
quarterly results.
Quarterly results, that's them. just took the words right out of my mouth. Now we want to know. Now the metric's going to look at is the big one. It's free cash flow yield, and what that is, right? So free cash flow was saying, right, how much was added to the balance sheet in the quarter, but what is the yield of that free cash flow in relation to their market cap size? So, bigger market cap, we're assuming that free cash flow should be higher. So what the higher the yield is, how much cash flow they're generating in relation to where they're trading.
Now, someone with a CFA will be quick to point out that this is our free cash flow yield to equity, i.e. it's called the levered free cash flow because you're dividing by the market cap as opposed to unlevered free cash flow yield, which would divide by the enterprise value. So,
yes.
So just for the CFAs out there.
Love it. Now, the free cash flow yield we're going to say is annualised. So we're assuming that the free cash flow bill for this quarter, we've just times that by 4 as an annualised rate. So this is a reflection on how their free cash flow yield for this quarter. So I'm going to just make this graph appear. First cab off the rank.
Show me, Matty. By the way, with your free cash flow, I should point out that you did make some modifications. You basically ignored any change in cash that came about via the issue of dividends or via acquisition sort of payments, and you're trying to capture the rest of the change in cash.
Yeah, and it reflects, like Silver Lake's case, it reflects that their investment in Red 5 is considered part of their cash and investments. It's all in one pool.
Yeah. Beautiful.
Yep. Righto, start off with the old market darlings, Capricorn, CMM. So they're $1.75 billion market cap, Capricorn. So they added $26.50 cash bill for the quarter. That brings them to a 6% free cash flow yield for the quarter based on their cap. So they've still got $160 in the bank. So remember, Capricorn actually, they paid out some of their hedge, so they're unhedged at the moment, but those hedges kick back in FY25, I think for 6 quarters till December quarter 26. So I think it's 207,000 ounces hedged at 2,300 odd.
Gotcha.
So it's about 28% of their production, courtesy of the great Timmy McCormack's note that I just read. Thank you, T-Mac.
So in effect, annualising this quarter's free cash flow might not be an accurate representation of the business's future-looking free cash flow.
It's a bit of a there is that significant hedge coming up, which is very Regency, you'd say.
Listen to the interview with Sean Russo for more details on that one.
Yeah. So look, whether they might pay it out again if they got the free cash flow like they did with this, but we're yet to know. So next cab off the rank, Emerald, $28.8 million bucks added to the bank. 5.5% free cash flow yield for the quarter. So their market cap's 2.08 billion. So they've got 137.8 million in the bank, but they've got 30 mil US in debt owing. So net cash position of around 92.5 million Aussie. So but they also have that 78% stake in the Bullseye. So Emerald offered that, did that all scrip offer mid last year. Still open. Acceptance date has been extended to 20th of February. So they're, I think it's one of the major shareholders is holding out on that. So it might be similar to the Dacian setup we've seen with Genesis. It might be overs offered, but it has been extended to 20th of Feb.
You know what I noticed about your first two companies there? Both of them single asset producers, but they have a development project. So their market cap today is factoring in the net asset value of when they bring in their growth project into production.
Yeah.
Just big gold open bits.
Yeah. Hence, you on those two numbers, you're getting a lower free cash flow yield than the next two you'll reveal because they have, tangible growth projects that the market is pricing in that they're going to execute on.
And next
Absolutely.
one is one.
I was going to slot that in.
Sorry,
I was going to slot that in at the end there, but you're definitely right. We've spoken in the past about Capricorn and how that market cap is well and truly factoring in plenty of growth and successful growth to come through Mount Gibson.
Now, next cap, Ramelius, RMS, added 43.3 million for the quarter for their cash. So that gives them 9.6% free cash flow yield. So they're 1.8 billion market cap, so around pretty similar size to Capricorn. $282 in the bank, so sitting pretty there. Now, the leader for the quarter, gentlemen, here we go. The revealing, here it is. The chart itself. Silver Lake Resources added $44.9 for the quarter, 16% free cash flow yield because they're trading at a market cap of 1.13 billion. But as we know, depleting resource rapidly, haven't really got that growth project that we can think of. Sugar Zone on care and maintenance. They closed out their $130 facility that they used to purchase their Red 5 stake. So their total cash and investments at the moment is sitting at $427 million. So they did added a lot of cash this quarter. So they've started. I think they depleted the Mount Munga stockpiles by 5,000 ounces. Didn't you say?
Yeah, but they built inventory at the at
Deflector. So they've got a shitload of ounces sitting there in stockpiles. But yeah, the big question is with all this cash and investments, what is Silver Lake's long-term move? Because Deflector and Mount Munga definitely isn't it.
Both Ramelius and Silver Lake, maybe have the higher free cash flow yields on this one because they have shorter reserves life on their assets and they don't have as tangible a growth, a growth story to bring online. And Silver Lake, the most kind of beaten up of the two of them, which is maybe why they've got that really high free cash flow yield because the market's not rewarding the equity. Yeah,
exactly. So yes, there we go. Bloody Silver Lake, they might just go into banking after this because they're going to have that much bloody cash on hand.
Mate, you'll be going into banking with charts like this, mate. What a treat you've given the money.
Mate, I would not want charting to affect the value I deliver to the great money of mine partners, like that's my prime focus is keeping them and the money miners happy and keeping JD happy. You know what makes JD happy?
Tell me.
Hastings.
That was definitely top of the list, Matty. couldn't agree with you more. But I'm super keen to hear what you've got to say here, Trav, because I was flicking through all the announcements this morning, and there's two or three, and I'm thinking, do I really want to chat about these companies? For various reasons. But you came up with the great idea of why don't we talk about three formerly hot stocks that are now in the sin bin, and top of that list is Hastings.
Yeah, with news out today. Mate, let's do it. Let's talk about the sin bin stock. So Hastings, as pointed out in a tweet by Chucky, if you simply read Hastings quarterly, you might get the wrong impression about their capital structure. You go to the appendix of the 5B, section 7, where you talk about your financing facilities, and it's blank. Nothing filled in there. So you might be thinking, oh, geez, they don't have any debt, no borrowings, nothing funky like that in the cap structure. But Don't you guys remember the convertibles with Wailu? Yeah, well, the notes. Oh man,
Should that be
I
in
remember
there?
them. You often do see people, like add a bunch of colour about their convertibles in the 5B. I think it should be in there. I just think like if you want to get a full picture of the capital structure by opening just the last quarterly, that's my opinion.
Pull up Adriatic, for example, and you'll see the ones they got from Queens Road. You'll see them in there today.
So you check the annual report, and there it is. The convertible with Wailu is right there. That's pretty chunky. So when I opened the annual report to double check this and, of course, find details of the convertible in the annual report, I couldn't help myself, but I scrolled to the section in that annual report that talked about exec remuneration. And look, gentlemen, I was disappointed, but unfortunately I wasn't surprised with what I found there. The remuneration here for a company with no operating cash flow boggles the mind. Despite none of the project hurdles being met in FY23, the board still exercised its discretion to vest 20% of the performance rights. Oh, and how's this sentence, guys? In recognition of the successful completion of the capital raise and Wailu and Neo investments over the year, the board awarded the executive chairman, the former chief financial officer and the former chief operating officer a discretionary cash bonus of $400,000, $200,000 and $150,000 respectively.
Fuck me.
You'd have to wonder what they got paid if they did their jobs well.
Mate.
So you're getting a bonus for raising money.
Well, maybe that's the business model. So, look, mate, to be clear, both the former COO and the former CFO resigned before the end of the financial year. And when I was working in investment banking, if you pulled the pin and quit your job before the end of the financial year, say goodbye to your bloody bonus. Mate, farewell to any discretionary bonus there. That's gone. You better hope that someone else that you're getting hired by on the way in will make up for it because that discretion's gone the moment you leave. So I'm reading this and I'm pretty pissed, to be honest, because in my opinion, like there's no respect for shareholder capital here. And to really articulate the point, take the executive chairman of Hastings, Charles Liu. So I looked at his remuneration. His fixed remuneration increased from $570,000 per annum to $620,000 per annum in FY23. So that's $620,000 per annum plus the discretionary $400,000 performance bonus he took home in FY23 equals greater than $1 million that year in a year where the company's stock price fell 66%. Does that sound like performance to you guys? So $1 million cash for a company with a market cap of now $77 million, mate, just go figure. Like,
oh, mate, it's all right. We'll make that with money in mind, but we'll do it ethically.
Oh, fuck, mate. If we don't take in equity, mate, we're bloody, we're 90% of the way there. Jeez.
Anyway,
that is astounding.
Yeah, I'll wrap it up with, one other thing I was just thinking about there. So, that sort of money, right? We talked about the convertible with Wailu. They've got to repay that money in October next year. Like, where are you going to get that money from to repay Wailu with? Because Wailu's got security over the Neo shares. So are they is Wailu just going to get the Neo shares and then what does that mean for Hastings? It's pretty freaking grim. So just bloody, mate, you should be trying to preserve the cash to bloody meet your repayments rather than doing the opposite, in my opinion.
So is that posing Wailu in a pretty good spot to convert that pretty easily, or what?
Wailu's got security over the shares if they don't get repayment, but based on the relative share prices since, I can't see, Wailu doesn't win with the conversion price that's set in there. They
but they need to be paid back.
Yes.
Yeah.
Correct.
Yeah. Right. Lake Resources boys, what's going on there? Keep the good stuff flowing.
So they didn't release a quarterly today, but instead announced an extension to an existing financing mandate. And to be clear, in my opinion, this is not newsworthy, let alone market sensitive, as it was uploaded to ASX today. So Lake announced that their existing engagement with Citi and JP Morgan as joint coordinators for proposed debt finance has been extended. You might be wondering, what is a joint coordinator of debt finance? I had to ask that question myself.
I used to be a joint coordinator at uni.
Did you?
Yeah.
Oh, mate. All right. Well, I asked someone, not you, Matty, but So because in addition to these global coordinators that they've got Citi and JP Morgan, they also has other debt advisors, 2 of them being GKB Capital and SD Capital. Apparently the difference between a debt advisor and a coordinator is a coordinator ordinarily will provide some of the finance package themselves. My friends in the debt advisory world told me companies tend to have to pay a fee for that though. And when you read the announcement, you've got to wonder if the objective was to name 3 global bulge bracket investment banks, all of whom I'd expect to be paying before the substance of the announcement even begins. So I've highlighted here Citi, JP Morgan, and chuck in Goldman Sachs as well for the equity thing, which is unrelated to what happened today. So look, just a reminder for the money miners on 19th of December last year, which was after we hung up the boots on the podcast. It was a few days later, well timed by them because we didn't talk about it. Lake dropped their phase 1 DFS for Kachi. It was pretty grim. CapEx a whopping $1.4 billion. But that excludes the grid transmission system estimated to cost another $390 million that someone will build. NPV though, $2.3 billion. But the lithium price deck, Matty, JD, this was a funny one. They paid us for a special price deck, a special price, deck with Wood Mackenzie, and they popped out this one which had an average price of US $33,000 per tonne for battery grade carbonate. And now obviously Wood Mackenzie have changed their outlook, and what do we know? The current prices are less than half of that at US $14,000 per tonne right now. So if you're wondering why they even bothered to bloody put the study out, given how grim I thought the numbers were, well, Mondi on Twitter has the answer for you. He posts, show me the incentive and I'll show you the outcome. A 40% weighted KPI for the Lake CEO and CFO to release the DFS in 2023 probably explains why the stupid lithium numbers were input to make it look vaguely palatable. And with study numbers like that, I'm left thinking the only way Kachi could possibly get debt finance that its global coordinators are there to coordinate is if dumb money, wait worse, taxpayer money gets it there.
Matty, that's a perfect example to one of the questions we had served up on the episode we did on Friday regarding commodity, price forecasts. You just got to look at the incentives. None of these barely any of these players are truly independent in forecasting their commodity outlooks.
It appears so.
I think Wood Mackenzie had left out the African supply in their supply and demand model, I heard.
Oh, that's the word on the decline now. They've put it in, and hence it's $14,000 a tonne.
Something like that. They might correct us, mate. Anyway, Vulcan. When we were talking on the phone earlier today, JD, I was like, we'll do 3 companies in the sin bin. And I typed out the top 2 and I just didn't have any energy left. So I'm going to go easy on Vulcan just because I was already too angry. But I'll keep it brief. Remember when when Vulcan acquired these geothermal rigs as announced to the market in November 2021? Right, when they said they'd be using them to drill by end of 2022. I've highlighted it here. Well, it's now 2024 and they still haven't drilled yet.
We might be waiting a while for that one, boys.
Oh, there you bloody go then. Right, good show, boys. Love your bloody work. What a day job. Thanks to all the
What a day job. The quarterlies keep us busy.
Oh, I love it.
One more day of them left. It's 31st tomorrow.
Oh, then the name and shame.
Oh, we might have to.
Looking forward to that.
That's a good point.
Name and shame for Thursday.
That's right.
Feb 1st.
Yeah.
Exciting time. No, February 1st. Bloody love it. Right, thanks to the bloody partners. The partners bloody love yous. InvestorHub, DSI Underground, Terra Capital, McMahon Mining Title Services, who are probably merging with Brooks Airways and the Brooks Group as a whole. Future Proof Consulting, Anytime Exploration, KCA Site Services, and K-Drill, the BHP Explore program. Hootaroo, money.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.